Hello, welcome back to the Startup College Business Data Analytics course. Today we are looking at analysis of financial statements by use of financial ratios. And before we delve in, maybe it's important to look at the certain types of financial ratios that we have and the purposes of each. Now, financial ratios are important for several factors. One of the factors is risk analysis as well as comparison. So how does it do risk analysis? Now, we have companies that are of different sizes, right? And a company may have a certain level of debt that could be justifiable for that type of size. So for us to understand the context, we need to compare the debt level by, let's say, another element of the financial statement, such as the total assets of that company or equity. So that is what basically financial ratios do. You express one element of a financial statement in relation to another. For instance, we have liquidity ratios. Now, liquidity ratios usually measure the liquidity of the company. How will the company be able to cater for its current liabilities when they fall due? So we have current ratio, which is calculated as current assets divided by current liabilities. We have the quick ratio, whereby quick ratio is simply the current ratio, but now you are not including the inventory. You want to get a clear view of how well the company can pay its current liabilities when they fall due. Then we have a myriad of profitability ratios, such as the gross profit ratio or the gross profit margin, which compares the gross profit to the revenue. So again, you can compare two companies of different sizes by using the gross profit margin. This is because when you use the absolute figure for profits or net profits or gross profit, you might not get the full picture, because a company might be so big and has millions in profits, but when compared to the revenues generating, it is very meager. Whereas another company may be very efficient in generating profit from the revenue that it has. So you have gross profit, you have operating profit margin, return on equity, which compares the net profit to the total assets. Then you have the return on equity. Equity compares the net profit to shareholders' equity. Then we have efficiency ratios. Now, efficiency ratios usually measure how efficient is the company in utilizing its resources to generate revenue. Now we have asset turnover, which compares how efficient is the company in using its total assets to generate revenue. Then we have inventory turnover, how efficient is the company in using its inventory to generate revenue. Then you have accounts receivable turnover, accounts payable turnover, and the formula is there. Then we have the solvency ratios. When I was talking about risk, now this is the ratios that usually measure risk, because you're comparing, for instance, the debt to equity ratio compares total debt to shareholders' equity. Then you have debt ratio, which compares total debt to total assets. Then you have interest coverage ratio, which compares the earnings before interest and tax to the interest expense. Then you have the market value ratios, such as price to earnings ratio, dividend yield, which is dividend per share divided by market per share. Then we have the growth ratios, which simply show you at what rate has the company grown within the period under review. Well, now that we have taken a snapshot of the financial ratios that exist, we are going to do it practically by help of a sample question. Now we are provided a sample question here, and the first step is to read it. And it reads, you are provided with the following financial statements for Little Bird Company. We have the profit and loss for 2023. We have the profit after tax and all those sales and all those elements. Then we have the balance sheet for 2021 and 2023. Then we are asked, calculate at least two ratios under each of the following. We have profitability, we have liquidity, we have efficiency, and we have solvency. So the first step as usual, is to copy down the data to Excel, to transfer this data to Excel. And you can just highlight them as is, like that, all of it until you get to the total liabilities and equity. Hit Control C, open up Excel, and I want to just scroll underneath here under the where we have the formulas, and on cell A33, hit Control V, and then to readjust the columns and the width of the columns and rows, now that is highlighted, hit Alt O C, first of all escape, so Alt O C A, and you can see it automatically readjusts the widths. So we have the profit and loss account and the balance sheets for the 2 years, and the first ratio we are required, profitability ratios. The first one, let's talk about gross profit ratio. Now gross profit ratio is calculated as the gross profit over revenues. So what do? We type in equals, we click on the gross profit over revenue for the period. We have 0.3. We can convert it into percentage. Home and then percentage. Second profitability ratio, let us use the net profit margin. Come here, equals the net profit for the year, profit after tax, divided by the revenue for the period, which is 100,000. Hit enter. 0.06. Can convert it into percentage as well. Those are profitability ratios. We are required to calculate at least 2. You can go ahead and calculate the rest since you have them. We have net operating profit margin, you have return on assets, return on equity. Maybe let us do return on assets. Let us do return on assets. Here we get equals net profit or profit after tax divided by the total assets. Now remember, this is 2023, so we take the 2023 figure to assets, hit enter. Here we can convert into percentage and add 2 decimal points. We have return on equity. Work it out. Second ratio we are required to look at is liquidity. So liquidity, and the first one, let us look at the current ratio, where the formula is current assets divided by current liabilities. So for 2023, we can break it down. You can say 2022 and 2023. So for 2022 is equals total current assets. Where is the total current assets? That figure divided by total current liabilities. Total current liabilities. Hit tab. Then you drag it like that. So we can see it increased. Let us look at the acid test ratio. The acid test ratio, it's gonna be total current assets minus inventory divided by total current liabilities. So what is the total current assets for 2022? That figure minus inventory divided by total current liabilities. Right, we have those. So the next, we can be asked to interpret this data, and the way we interpret, for instance, we can see that the current ratio is more than 1 and it's increasing. We can say With the current ratio, let us type it down. With the current ratio that is greater than 1, it can be concluded that the company will not face difficulties to pay its current liabilities when they fall due. Right? The acid test ratio, and also you can see it's increasing, right? So the company is improving. So when it comes to liquidity, the greater the current ratio and the greater the acid test ratio, the better. The next class of ratios you're supposed to calculate, efficiency. Just type there efficiency. Some of the efficiency ratios that we have are asset turnover. Let us calculate that. The asset turnover. So for this one, it's only for 2023, since we only have the profit and loss account for 2023. So asset turnover is gonna be revenue divided by total assets. So equals revenue divided by total assets. And it's not just total assets, it's average total assets for 2022 and 2023. So we can write average, open brackets, total assets. Then you just highlight the two, which is B61 to C61, close brackets, hit enter. So the asset turnover is 1.087. Which is the other one? You can be asked to interpret this, and the way you interpret this, you can say, with that asset turnover of more than 1, it implies that the company has been fairly efficient in using its total assets to generate revenue. The next efficiency ratio we can look at is, let us look at inventory turnover. Right? Let us look at inventory turnover. Right there, inventory turnover. And the formula for inventory turnover is cost of goods sold divided by average inventory. Remember, it is cost of goods sold and not revenue. So equals, and our cost of goods here sold is in negative, so we introduce a negative sign to bring it back to positive. Cost of goods sold divided by average inventory. So right, average, open brackets, and then you come here where the inventory is, highlight that, which is B58 to C58, close brackets, hit enter. We have an inventory turnover of 3.6845. With an inventory turnover of 3.65, we can say the company has been very efficient in using its inventory to generate revenue. So it shows that the company turns over its revenue or its inventory about 3.6 times in the year. Right? So we have efficiency. And the last ratio is solvency. Solvency ratio. So type in solvency ratio. Solvency, you can just write solvency. So some of the solvency ratios we have include debt to equity ratio, which is calculated as total debt over shareholders' equity. So we say debt to equity ratio. Total debt. So this is for 2023. What is the total debt? Total debt is same as total liabilities over total equity. which is that. Hit enter. So for this, we can maybe do for 2023 and 2022. So let's write 2023, 2022. So we can drag this formula back like that. That's debt to. We can see that the debt to equity ratio has been declining, right? And with a debt to we can interpret this and say, with a debt to equity ratio that is greater than 1, it implies that the company's assets are financed more by debt than equity. This could expose the company to higher financial risks, right? We can interpret it as such. The next one is debt ratio, which is total debt by total assets. Say debt ratio, which is total debt by total assets, equals total debt, which is total liabilities, by total assets, which is B61. Hit tab, then you can drag it as such. Same conclusion, same interpretation as the debt to equity ratio, right? So when you have a debt to equity ratio that is greater than 0.5, it implies that the company's assets are financed more by debt than equity, which exposes the company to a higher level of financial risk, right? So we have calculated the profitability ratios. We have calculated the liquidity, the efficiency, and the solvency level ratio. We have satisfied the question, but maybe we can do one more solvency ratio, the interest coverage ratio. Interest coverage ratio. The interest coverage ratio is earnings before interest and taxes divided by the interest expense, right? Earnings before interest and taxes divided by the interest expense. So under this, the first step, you are going to have to calculate the earnings before interest and tax, right? Earnings before interest and tax, right? And the earnings before interest and tax, we pull up to the profit and loss account. We are going to take the net operating income minus or plus minus the depreciation expense. So here we say plus because it is in negative. So let's say plus the depreciation expense. Now that is the earnings before interest and tax. The interest, we already have interest. Let us just bring it up. Interest here, we have it as 1,000. So we say minus this figure to get that. And we are told the interest coverage ratio is EBT or EBIT, earnings before interest and tax, divided by interest expense. So to calculate that, is gonna be EBIT, which is B94 divided by B95, which is 10 times, right? So if the interest here, we can interpret this and say the interest is covered 10 times by the earnings before interest and tax. This implies that the company is exposed to minimal risk of being unable to pay its interest expense when it falls due, right? So we've been able to use the financial statements provided to calculate the profitability ratios, and not only that, we have been able to give interpretations. For profitability, you might need to compare it with a benchmark. Maybe you are provided with several benchmark companies and you're given their profitability ratios or the average industry ratio. Let's say, for instance, the average net profit ratio is 5%. The average industry is 5%. So you can say Little Bird Company recorded a higher profitability margin than the industry average, implying that it is more profitable than the industry, right? And you can be given all these others, such as the efficiency. So what you do is to perform a benchmark analysis. You have the financial ratios of your company of interest. You compare it versus the industry, and then you make a conclusion, right? So if the liquidity of the company is higher than the industry, you say that it is more capable of paying its current liabilities when they fall due compared to its competitors, right? Same to efficiency, same to solvency, same to the debt ratios and all that, right? So that will be the end of our video today. We are going to meet next when we are talking about when you are performing further analysis of financial statements using trend analysis or common size financial statements. Until then, happy analyzing.